Welcome to The Explainer. Today, we're going to tackle something that looks super complicated: financial charts. Our goal? To show you how to turn that screen full of lines into a story you can actually read. You know, when you first look at a price chart, it can just seem like pure chaos, right? Just a jumble of lines and colors, no clear direction at all. But, and this is the cool part, hidden inside all that noise is a really clear story. And to understand that story, all you have to do is learn its language. That language is called market structure. So, in this explainer, we're going to teach you the basic grammar, the ABCs of market structure. We'll turn this confusing picture into a clear narrative. All right, let's dive right in. The first, most fundamental thing you need to get is that the market can really only be in one of three states, or as I like to call them, moods. Yeah, it's actually that simple. At any given moment, the price is either going up, it's going down, or it's just moving sideways, kind of stuck in this holding pattern. So, the two main directions you'll hear about are bullish and bearish. Bullish, that's when buyers are in control, pushing prices up. And bearish, that's when sellers have the upper hand, driving prices down. Ever wondered where those weird terms even come from? Well, it's pretty cool, actually. A bullish market is named for how a bull attacks. It thrusts its horns up into the air, a perfect symbol for prices being driven higher, right? And on the flip side, a bearish market gets its name from a bear swiping its powerful paws downwards, representing prices being pushed lower. It's a really simple visual, but man, it helps the concept stick. Okay, so what about when the market isn't clearly bullish or bearish? Well, that's when it's in consolidation. This is when the price just gets trapped in a range, moving sideways. You'll hear people call it a choppy market, and that's basically because there's no clear winner. The bulls and the bears are just locked in a stalemate. So the big question is, how do we actually see these moods on a chart? How do we spot them? Well, it all starts with identifying the market's fundamental building blocks, and those are the turning points. Okay, first up, we have what's called a swing high. Just think of it like a peak on a mountain or a crest of a wave on the chart. Visually, it makes this really distinct A-shaped pattern where one candle's high is clearly higher than the candles right next to it. These peaks are super important turning points. And the opposite is, you probably guessed it, a swing low. This is like a valley or a trough on the chart. It forms this really clean U shape where a candle's low is lower than the candles on either side. These valleys, they're the other key turning points we're hunting for. All right, now let's see how connecting these dots, these swing highs and swing lows, starts to reveal the market's bigger story, its trend. And this is where the language really comes alive, because identifying that trend, well, that's what helps you figure out what to do next. So in a bullish market, an uptrend, the story plays out in this simple, repeating rhythm. The price makes a new high, it pulls back a little, and then it pushes up to an even higher high. It literally looks like a staircase going up, built from a series of higher highs and higher lows. And no surprise, a bearish market tells the exact opposite story. It's a staircase heading down. The price breaks below its last valley, creating a lower low. Then it pulls back to a peak that's lower than the last one, that's our lower high, before it heads down again. See the pattern? So here's a super simple way to lock this in. An uptrend is all about breaking its old peaks and protecting its valleys. A downtrend does the exact opposite. It breaks its old valleys and protects its peaks. Basically, the trend is telling you what's strong and what's weak. Okay, so that's all the theory. Now for the fun part. Let's turn all this into a simple, step-by-step process you can start using to read any chart, like right now. Now, this is probably the most important rule for beginners, so listen up. Ignore the noise. Seriously. Don't get lost in every tiny little wiggle on the chart. Instead, find a clear top or bottoms to start from and look only for the most obvious clean A and U shapes. When you connect just those clean points, that's when you'll see the real story unfold. And that's really it. By understanding those three market moods and those two simple building blocks, the swing high and the swing low, you've just learned the basic grammar of the market. You've officially gone from seeing random noise to actually reading the story on the chart. So the only question left is, what story will you see next?